The One Big Beautiful Tax Act. Many people are saying it's big. Many people are saying it's the most beautiful. Some are even saying it's the most big, beautiful tax act ever. Let's talk about it. Hello, everybody. Joe Warpick coming at you. And the One Big Beautiful Bill Act has recently narrowly passed the House of Representatives and is moving on to the Senate. But the most important aspect is, what is in it? What does this mean for you? And is it going to pass the Senate? Well, let's take a look. Let's start with one of the most important aspects of the OBA, and that is the standard deduction. Every American out there will now get a $15,000 standard deduction starting in 2026 for 2025. That means the first $15 that you earn does not count at all towards your income. Two of the biggest changes are, number one, no tax on tips. Now, it's a little bit less interesting as it sounds, but if you are a server, you work in a restaurant, you work in a bar, you work somewhere where the major portion of your income is tips, you will be able to deduct, and when I say deduct, you will be able to reduce your income up to $25,000 worth of your tips. And these are cash tips, or these are cash tips that are placed on a credit card. That means if you are a server and you are single, you get to reduce your income by $25,000 for tips, and you get the standard deduction. So the first $40,000 that you earn as a server completely disappears off your income. That's pretty huge. The tips deduction is phased out for people who make over $150,000 as an individual and $200,000 as a married couple. Second of the largest changes is there's no tax on overtime. This is gigantic. So if you are in an industry where you are receiving overtime, that means you're working above 40 hours and you're getting paid an overtime pay, which could be time and a half or 2 times, the federal government is not going to tax you on that money. That means that that amount of money that you earn weekly as overtime will not show up on your tax return. It will actually come off. It won't be a deduction. So you don't have to itemize this part. You simply have to have overtime, and that overtime will not be taxed. This is huge for those people who are earning overtime pay. The no tax on overtime is phased out for people who make over $150,000 individual or $200,000 as a married couple. SALT deductions. This is state and local tax deductions. It has been increased to $40,000. Now, this is difficult because this is a deduction. Since the standard deduction is now $15,000 a person or $30,000 for a married couple, your SALT deduction or your state and local income tax deduction would have to exceed that $30,000 in order for you to claim it, in order for you to itemize. Because the way a standard deduction works is you have to have deductions above the standard deduction in order to itemize, or you must go with the standard deduction. So they've increased it to $40,000, meaning that if you pay state and local taxes, that's income taxes and real estate taxes, you can now deduct up to $40,000 of those taxes. Unfortunately, this is phased out for higher earners. For instance, if you're an individual who makes over $500,000 a year, you will not be able to deduct the state and local income tax deduction. Another great option is if you buy an American car between the years 2025 and 2028, you can deduct the interest up to $10,000. Now again, this is only if you itemize. So if you don't have deductions exceeding $30,000, this is kind of useless because you have to have deductions above that $30,000 in order to use the $10,000 deduction on your auto. So this will not be used by a lot of Americans. The best news is that the 2017 Tax Cuts and Jobs Act are now placed permanently into the tax code. That means that if the Senate passes this bill as is, going into the year 2026, we will not see an increase on income tax rates. Currently, those tax rates go from 10 to 37%. They were set to go from 10 to 39%, and every bracket from the 12% bracket up to the 37% bracket was going to see about a 2% increase. So the 12 was going to become 15, the 37 was going to become 39. That is going away if the bill passes the Senate. This is great news because I did a video before saying that the average American's taxes were going to increase by 50%. And so if this bill gets through the Senate, your taxes are not going to go up next year. In fact, with the increased standard deduction, your taxes will actually go down. Child tax credits increasing from $1,000 to $2,500 for people who qualify. And there's a new MAGA account that can be created for anybody who has a child between the years 2025 and 2028. The US government will give you $1,000. They will deposit that $1,000 into a MAGA account. That account is able to grow tax-free until the child reaches age 18, at which time, if the money is spent on qualified expenses, that would be higher education, first-time home buyer, or business startup costs, that money can come out and you will simply pay a capital gain and not ordinary income tax. If you pull the money out beyond 18 and you spend it on non-qualified, then you will have to pay a 10% penalty and ordinary income tax on the growth. This is Trump's way of trying to convince people to have more kids. Our childbirth rate is falling dramatically in this country, and it's great that the government is saying, here's $1,000, but I don't know if $1,000 is going to convince anybody to have a kid. But if you do have a kid, hey, you get $1,000 in an account and it gets to grow, and you're actually allowed to add money to that account if you want to. I'm not sure if it makes sense. We'll have to wait to see the final bill. We'll do a video on what the MAGA account is going to look like and how it could affect your child and their financial future. And one of the final areas that we've seen in this bill is that they will keep the qualified business interest deduction for individuals who own partnerships or S corporations. And what this deduction allowed you to do was take a 20% deduction of your EBITDA, or your earnings before interest, taxes, and depreciation. So let's say your business earned $1 million of EBITDA. You could deduct the first 20%, or $200,000. You basically would remove that $200,000. That's non-taxable income. Not only is this going to stay as part of the tax plan permanently, it's going to be increased from 20% to 23%. So that same individual who could deduct $200,000 on that $1 million of earnings can now deduct $230,000 of income that they will not have to pay any taxes on top of their $15,000 standard deduction. So now an individual who runs a business and earns $1 million could have a $245,000 tax deduction before they even begin paying taxes. One last area I want to talk about is the immediate depreciation on large purchases for business owners. This means that business owners will be able to make large qualified purchases and then depreciate that asset in 1 year. This has been used in the past to purchase things like private jets. You buy a $2 million private jet, that means you get to depreciate the entire $2 million in 1 year. That means that you get to knock $2 million off your income, which means that if you bought a $2 million jet and you had more than $2 million of income, which you probably would if you're going to buy a $2 million jet, that $2 million at 37% is going to save you $740,000 off your taxes. So basically what this is doing is this is allowing wealthy business owners to purchase large items like a jet and get up to a $600,000-$700,000 reduction on the cost of that, because it's going to be a reduction on their taxes. I buy a $2 million jet, I get $740,000 off my taxes. That means that other taxpayers just paid me $740,000 to buy a $2 million jet. Not a bad deal. Now, what's not in this plan? The largest piece that's missing from this plan was Trump's promise to not tax Social Security. It is not in any of the bills that we've seen. It's not being discussed in the Senate. It did not make it through the House. So in exchange for that, what they did was they increased the standard deductions for seniors. So anybody over 65 will not have a $15,000 standard deduction. They'll now have a $19,000, or as a married couple, you would now have a $38,000 standard deduction, which means as a married couple over 65, the first $38,000 of earnings that you have will be reduced by your standard deduction. That's pretty big. That is going to help a lot of people reduce the taxes, maybe even eliminate the taxes on a lot of their Social Security income. But most importantly, how is this going to be paid? Typically when a bill is presented, one of the last sections of that bill explains how they're going to either cut taxes in areas or increase revenue in other areas to pay for it. But in case of the one big, beautiful tax bill, this is what they have to say. The last section shows us that the way we're going to pay for this bill is by adding $4 trillion to our already $37 trillion of national debt. So this is the largest sticking point we're seeing in the Senate. The Senate does have issues with some of the Medicaid cuts. The Senate does have issues with some of the green initiatives that are going to go away because of this bill. And they are concerned that an extra $4 trillion on top of our already $37 trillion of debt is going to hurt future generations. So do I think it's going to pass the Senate? Yes. The Senate basically has a deadline, I believe, of July 4th to get this bill passed. I believe it will pass. I believe every one of the sections that I went over today will be in the new bill, because none of what we talked about today is a sticking point for the Senate. And I specifically chose not to talk about any sections that were a sticking point because I wanted to let you know what I thought was going to be in the final bill. This is great for the average American. You're going to pay less taxes going forward. You're going to have a larger standard deduction going forward. If you're a business owner, you're going to be able to pay less taxes as well. I don't personally see any issues with this. I'm kind of happy that we're seeing this bill passed because I was really worried about taxes going up for so many Americans in 2026. And with this bill, we will not see that happening. And that makes me very pleased. I'm not happy that we're adding $4 trillion to our debt. And I would like to see the government begin or continue to cut expenses in other areas, because I don't think they should be paying for the majority of their expenses by taking taxes from us. I like lower taxes. I think it spurs on growth. I think it spurs on the economy. I think this is an overall positive for the average American, and I'm hoping that it passes the Senate quickly. If you like videos like this, make sure you subscribe, leave a comment down below, turn on that notification bell to be notified when I come out with new videos, and as always, I'll see you next time.